So yesterday we stopped our discussion as far as the 5 ways in which shares can be issued. Okay, the first method was, I told you about that, it was an IPO, for which we have seen this particular diagram in the yesterday's class. Okay, so we have seen this particular diagram in the yesterday's class. Today what we'll do is we'll go a step further and try to find out, okay, we'll try to find out more in detail about all these 5 methods of issuing shares, right? So this is what we are going to do in today's class, right? So yesterday I told you about the only initial phase. I told you about how a IPO is been issued, right? Are you able to, by the way, are you able to hear me out?
Yes, sir.
Because I think there was some echo here. Fine. So we are going to discuss about something more in detail today as to how an IPO offer looks like. Today I am actually going to show you how an IPO offer looks like. I have taken the example of SBI cards. The issue for this particular company had come last year in 2019, and I want to show you how a prospectus looks like. Okay, so this is nothing to do with your academics. This is a plain practical knowledge that I am giving you, which is very important than your bookish knowledge, right? So I'm going to tell you what is a initial public offering, how does it look like, what are the information that goes on into it. Then we'll see what do you mean by FPO, that is follow-up public offering. Okay, then we'll try to find out the difference between these two, and then we'll go to FTI, that is fast track issue, and the other different types of methods, right? So all this we are going to study in today's class. So let us start our discussion. I'm not going to repeat whatever has happened yesterday. There were 3 phases that we discussed as far as IPO is concerned. First was the pre-approval phase, second was the marketing phase, and third one was the actual issuance phase. So this is how the public listing goes on, or the IPO goes on, as far as any new company wants to issue shares. We move on to the next one. So whatever was there in the previous slide, the same thing is repeated here. Only thing, there it was a flow chart. Here it is in the form of text. That's the only difference between the previous slide and this particular slide. Okay. Next, I told you that we are going to discuss what does a prospectus contain. That means whenever a company wants to issue shares for the first time, they should highlight as to why they want to issue shares, what is the use of those particular money that they are going to generate out of it, and where this money is going to be utilized, and what is return on equity on that particular investment avenue that the company is looking for. So all this information has to be made available to the people, because if they don't make it available, how will people give money to that company? So piling up of or seeing the contents of a prospectus is very important. So this is what the contents of the draft prospectus looks like, right? So just look at this part. We have the main heading. So we have definitions and abbreviations. There are some risk factors here. Okay, then we have part 1, which talks about general information of the company, the nature of business, everything related to management, the financials, the outstanding litigation, anything that is there, all this comes in the first part, and then we have the second part, and finally we have the third part, that is a declaration part of it, right? Now this is what I have been telling you, that these are the contents of the prospectus. But how does an actually prospectus looks like? Okay, that is what I'm going to just show you. So just have a look at this particular draft prospectus. It is from a company called SBI Cards. Okay, now just look at this particular some details that I would like to highlight. Of course, it's a 485 pages booklet, so I cannot go through each and every point. But what I'm going to tell you is, that is something very important. Now remember, the name of the company has to be clearly mentioned. Okay, so the name of the company is SBI Cards and Payment Services Limited. It is a company formed and registered under the Indian Companies Act 1956. Okay, it has a corporate identity number which is mentioned. Its registered office. Okay, its corporate office. Okay, and who is the contact person for this particular this particular issue that the company is going through, right? Next, it also says who are the promoters of the company. The promoter of the company is definitely State Bank of India. Okay, and what are they offering? They are offering an IPO. Okay, they are offering an initial public offering of how many
Sir,
shares?
sir, unable to see the slide, sir.
You are unable to see the slide.
Yes, sir. It's blank.
Just a minute. Just a minute. Give me a second.
Yes, sir. Yes, sir.
Is it visible now?
No, sir.
No, sir.
Now is it visible?
No, sir. Not visible.
Yes, sir. Yes, sir. Visible.
Okay. Fine. So can you see the name of the company here? Okay. The name of the company clearly mentions. Rohin, can you see this now?
Yes, sir. Yes, sir.
Okay. So name of the company is clearly mentioned here. Okay. No. What is the company all about? When was the company registered? It is registered under the Indian Companies Act. All these things are mentioned. Okay. The corporate identity number is clearly mentioned here. Okay. Who is the contact person for this particular issue? Name of that particular person is also mentioned here. Now, this is very important. Look at this. They have clearly said that we want to make an initial public offering. Okay, so the word has to be very, very clear. Okay, and the face value of the share is 10 rupees. Okay, the face value of the share is 10 rupees. And how many shares they want to issue? They want to issue somewhere around 5,000 million shares is what they want to issue, right? And see there, the offer is of 13 crore 5 lakhs 26,790 equity shares. That is the number of shares that they want to offer, right? So a huge money is required for this company, and that is the reason they want to make this particular offer. Okay, so these are the details of it. So the details of the promoters are mentioned. Okay, the face value of the share is mentioned. What is the face value of the share? It's clearly mentioned that it is 10 rupees here. Okay, next, I told you that the risk factors should be mentioned here, and who is the person who is going to take that particular risk, that has to be mentioned. So risk factors are mentioned. General risk is mentioned. Now come to something important. I told you something yesterday. I explained to you something about lead manager, right? In the yesterday's class, I did mention to you about the lead manager, isn't it?
Yes, sir.
Okay. So who is the lead manager in this particular case? So you can see there are, because the size of the issue is so much. Remember, 13 crore, 5 lakh 26,000 shares are going to be issued. So this cannot be done by only one company. So they need many people to help them out. So they have 4 lead managers. Okay, in fact, they have 6 lead managers. If you look at this, Kotak is 1, Axis is 2nd, okay, BFO is 3rd, then we have HSBC, Numera, and last one is SBI Capital Markets. So their own company is also part of the lead manager team, right? Who is the registrar for this? Okay, there is a company called Link in Time. So this company is the registrar of this particular company, right? Next, from what time is the offer valid? So you can see here the offer is valid from this day to this day. Okay, so all these things are clearly mentioned here. Now come to the next page. See, I told you that there will be 3 main sections. Section 1 talks about the general definition, abbreviation, the other conditions. Section 2 talks about some risk factors. Section 3 talks about why is the offer been made, what about the details of the company. So if you look at it, it's a 480 pages plus report. Okay, so everything about the company is clearly mentioned here. Why they need the money, who are the people who are who are the people who are managing that particular company, where is the money going to go, how will the money be utilized. All these things are clearly mentioned in this 480 pages report. So anyone who is interested to invest his money into shares, you will have to go through this particular report, and then you'll be able to get what are the details of that particular company. Of course, I did tell you about the legal, there is a legal department also. So these are the legal promoters of the company, or the legal advisors of the company. Okay, so international legal advisors, national legal advisors. So all details are mentioned here, and once you are through with it, then you can definitely go for the accepting this particular offer. Now, yesterday I also mentioned to you that there should be a banker for this particular company that is making a public offer. So the banker itself, SBI being a bank which is available in every nook and corner of India, so they themselves have acted as the bankers to the issue. In some cases, they have taken help of HDFC Bank. Okay. Also, they have taken help of other people also. I'll just mention the name. Yeah, these are the auditors of the company. Okay. So all information is available. Yeah, fine. You can see here Bank of Baroda also, Central Bank of India. So all these banks are going to act as feeder of money to this particular entity, and that is how the company is going to get money out of it. Okay. So my aim was to just show you how does a draft prospectus looks like. Can you see the screen now, the PPT screen?
No, sir.
Just a minute.
No, sir.
One minute. Just a minute. I think now you can see it. Can you see it now? Can you see it now?
Yes, sir.
Yes, sir.
Okay. So the whole point of telling you all this is I just wanted to tell you how does a draft prospectus actually look like. Fine. So we are going to talk about the draft prospectus. I've just shown you about the concept of draft prospectus. How does it look? What are the various information contents that it has? You know, all the details that the company wants to give or wants to share. As per the SEBI norms, all details have been shared, and if you are interested, you can definitely opt for this particular type of offer. So this is a initial public offer that has been made by all companies in India, and all companies have to follow this particular order itself. Okay, so in the last few days, there are some 3 IPOs that have come up. Okay, one is called Happy Minds. It's a mobile application based company. Their IPO is also in the similar way. Then we have one more IPO that is coming up, which is called CAMS, CAMS. Okay, it is India's largest mutual fund registrar company. So they are coming up with their offer. So we have many IPOs coming up. Basically, IPOs are done because whenever company needs money for expansion, for diversification, they need huge amount of investment. They cannot generate this amount of money in the form of loans from the bank. So the best way is go to the public and get money from the public and invest this money in your company. So this is how the overall concept of IPO actually works out. Clear? Okay. Next, we move on to the next type of public offering. This is called as FPO, that is follow-up public offering. Okay. Now, this type of offering is done by a company which is already listed on the stock exchange, which means, take for example, I am taking the name of a company called L&T. Okay. Now, L&T is a company which is already available on the exchange for trading. That means the company is already available in the stock exchange. In spite of this, if the company still wants to generate more money from the people, they can generate money by offering a FPO offer, that is follow up public offering. Okay, so FPO is the condition to get offer an FPO is only one thing, that the company has to be registered and the company should be available for trading on any of the stock exchanges. Okay, so once this condition is satisfied, the next condition is, that's point number 2 says, FPO company must satisfy the requirements of listing procedure. So whatever procedure that they had followed for IPO, the same process again has to be followed for an FPO. Okay, that is what it says. And last is, in 2011, there were 5 companies who issued FPO. After that, no major company has ever issued FPO in India. Of course, in days to come, there will be 2 more companies. So preferably, I think ITC is one company which is going to come up with FPO offering. The reason is they want to diversify into the masala business. Okay, you know that we have MDH, Everest, okay, and Badshah. These are the 3 main companies which are operating primarily into masala, ready-made masala business. Now ITC wants to land up into this particular business. For that, they require a huge amount of capital investment, and that is the reason they want to raise money in the form of FPO, that is follow-up public offer. So this is going to happen somewhere by October end or November, right? Fine. We'll move to the next one. From your exam point of view, this is a very important question that has been asked. Differentiate between what you mean by an IPO and an FPO. Okay. So I'll just tell you the main points here. If you look at the meaning, IPO refers to an offer which is made to the public for the first time. Okay, so the word is important here. Any offer that is made for the public for the first time, that is a IPO, right? Whereas an FPO is the company is already available in the stock exchange, but still the company wants the ITC wants to raise some fresh money, and that is the reason they should offer shares only through FPO. ITC cannot offer shares through IPO now because it is already listed. So the only way in which ITC can offer shares to the public is through the FPO method. Okay. Now it is applicable for all unlisted companies. IPO is applicable for all unlisted companies. FPO is available for all listed companies. So that is the second point of differentiation. Third is, whenever a company wants to raise money for the first time, it has to be done through only IPO, whereas any company wants to issue money after the first time it has already issued, or any subsequent times the money has to be issued, it has to be done only through an FPO, that is follow-up public offer. Next, as far as the risk is concerned, there is a high amount of risk because you don't know, since you are a new company, some people may take your shares, some people may not take your shares. So the risk level is comparatively high as far as IPO is concerned. But on the other hand, for an FPO, the risk level is comparatively low because your shares are already traded in the stock exchange, and you know that people are trading your shares. That means you are a well-known company, and that's the reason people are trading your shares. So risk level is comparatively very, very low. Okay. Next is, as far as the objective is concerned, okay, the main objective of is raising money through public investment. Here the objective is also raising money through public investment. So this is not a point of differentiation, but this is a similarity that we can see. Okay, we are raising money through public investment. Here also you are raising money through public investment. Only difference is, here you are doing it for the first time. Here you can do it repeated times. That is what we have to understand. Next, it is less predictable. It is highly predictable. When I say less predictable, you don't know how much of money is going to be generated as far as IPO is concerned. But when an FPO is issued, you know 100% how much of money is going to be generated out of it. Okay. Higher profit than FPO, because since the company is going to be listed for the first time, there's a high probability of profit being generated. Here, there is a low probability of profit being generated. So this is the point of differentiation as far as FPO and IPO is concerned. Okay, I'll just wait here for a minute. If you have any doubts, please let me know.
Sir, I have a doubt regarding this profit point, sir.
Which point?
Sir, the last point, profit.
Okay.
So in case of IPO, it's actually less predictable, right? And in major cases, sir, the companies are new. So how can you expect that the profit will be higher than this FPO? Because FPOs are offered by the companies which are already listed, and they are normally the reputed companies, sir.
Okay. I'll explain it to you in the form of an example. I'll take the example of SBI cards itself. Okay. Now, if Rashmi, if you want to invest your money for the first time in SBI cards, okay, the minimum amount that you have to invest, is somewhere in the range of 15,000 rupees. Minimum you have to invest is 15,000 rupees.
Yes, sir.
Are you able to understand? Now, why are you doing
Yes,
this?
sir.
Why are you purchasing the shares, or why are you accepting the offer of SBI? Because you feel that there is a high potential profit in that company. That is the reason you want to opt for that particular company. Will you ever opt for a company which is going to make a normal profit or a moderate level of profit by taking a huge amount of risk?
So, but that's what I'm saying, because I can't expect more profit from a new company also, right, sir?
No. See, here in the profit, don't be under the impression profit means balance sheet profit. No. As an investor, what is your profit? The money that you pay to buy the share and the money that you will get after selling the share, that is your profit. So don't think from the company's
Yes, I
point
got
of
it.
view.
Yes,
Don't
sir.
think from the company's point of view. Now, I'll give you a simple example of the same company of SBI cards, or for that matter, I don't know if you know the name of a company called Cochin Shipyards. Do you know the name of the company called Cochin Shipyards?
No, sir.
Okay, I'll give the example of the same SBI cards itself. Now, what happened is, uh, if you want to purchase one share of SBI card in that particular offer, the offer was around somewhere in the range of around 500 rupees, 500 to 700, 500 to 600 rupees was the offer that they have made, right?
Yes,
And
sir.
many people wanted to buy this particular company because it is a company which is into digital payment systems, and it is well integrated with the Nationalized Bank of India, which is also happens to be India's biggest public sector bank, and also most technologically advanced in terms of banking security is concerned. So this is all, these are the macro parameters in which people thought that it is better to invest in SBI cards. Okay, so this was the
Yes,
prime idea, and of course, uh, in the mode of digital payments, this company is definitely expected to do better. So with this intention, many people opted for this particular share. Now, when many people opted for this particular share, everyone did not get this particular share. I had opted for, I had opted for around 10 lots. Okay, 10 lots means I had
yes, sir.
opted for around 15, for around 100 odd shares. Okay, I had opted for
Yes,
100
sir.
shares, but how much did I get? I got only 19 shares, 1 9. I just got 19 shares in that particular lot. That means, like me, there were many people who had demanded more number of shares for that particular company. But ultimately, nobody got everything. Everyone got small pieces of bits and pieces of that particular offer that they was made. Now, for me, since my demand was not satisfied, what will I do? I will wait for the company to get listed in the stock exchange, and once the company gets listed on the stock exchange, I will buy those particular shares. Do you agree with me?
Yes, sir.
Right. So when I start buying those particular shares, what will happen to the stock price?
So obviously, when the demand is high, the price will rise,
The
sir.
price will shoot up, right? Now,
Yes,
just
sir.
imagine, Rashmi, you got the shares for 600 rupees. The stock got listed. It opened in the stock exchange for 800 rupees. It almost went to 920 rupees. Okay.
Yes,
Now
sir.
you purchase it for 600. The price is at 900. Forget about the 920 rupees. Forget about those 20 rupees. But from 600, the share went to 900 rupees. Have you not made a profit of 300 rupees in just a couple of 15 days? And this is, I'm talking about only one share. By the way, you cannot buy one share in IPO. You have to buy one lot. Okay. One
Yes, sir.
lot is somewhere around 20 shares.
Yes, sir.
So 20 shares into 300 rupees. What is your profit?
6,000, sir.
6,000 rupees your profit. What special efforts did you take to earn that 6,000 rupees? Absolutely nothing. You just
Nothing,
made
sir.
an offer, you accepted the offer, you paid the money, you waited, and then you sold the share, you got a profit of 6,000 rupees. Now, don't you think there is a high potential of you earning a profit because of the demand for that particular shares?
Yes, sir.
Now, let us come to FPO. Don't you think that I'm giving an example of ITC now, because ITC is
Yes,
about to
sir.
come with an FPO. Now, ITC is currently trading in the market at 141 to 145 rupees per share. That is the price that has been traded. Now, if any company wants, if ITC wants to issue some more shares, can it offer shares at 141 or 145? They cannot do it. Then people will not buy it because it is readily available in the market. So why should I take the offer from the company, right? So what
Yes, sir.
company has to do? Company has to offer at least 10% lower than that. At least 10% lower, right?
Yes,
Which
sir.
means the company will offer only at the range of around say 130 to 120 rupees per share is what they can offer, right? So
Yes, sir.
now you are getting the share which is available in the market for 140 rupees. You are getting the same share for 120 rupees. Clear?
Yes, sir.
This is
Yes, sir.
ITC FPO offer. IPO SBI cards offer is, you have a share for 300, 600 rupees. The market is ready to take the share from you at 900 rupees, which is more profitable. Now you tell me.
Yes, sir. Got it, sir.
Ready? So when things are
Yes, sir.
readily available in the market, its value comes down. If things are not easily available in the market, its price shoots up if there is a demand for that particular share. Clear? So this
Yes,
is
sir.
what you have to understand as far as profit levels are concerned. By the way, I
Yes, sir.
want you to go through the website. There's a company called CAMS, CAMS. Okay, I will
Yes,
show
sir.
it to you, CAMS. So if you refer CAMS, CAMS is also a very good IPO. You can definitely think of investing.
Yes, sir.
Next, we have the third level. We call it as fast track issue or FTI. Okay, it was introduced in India by SEBI in the late 2017, 2007. That is November 2007. It was established or it was introduced in India. Okay, now what is FTI? FTI stands for fast track issue. Okay, now IPO and FPO takes a lot of time. There is a lot of effort that goes on. There is a lot of time that has been consumed. So if companies have time, so much of time to wait and then generate money, companies can wait. But there are some companies who do not want to wait for a longer period of time. In such case, such companies always go for an FTI type of issue. So FTI definitely, as the word says, fast track issue. Okay, so the money is generated very fast. So let us try to understand who are the companies who are eligible to issue shares through FTI and what is the amount of money that they can generate out of it. Okay, so look at the second point. It says in a FTI, only well-established and compliant, that means legally compliant companies can issue shares or write shares through this particular offer. Okay, so any new company is not eligible. A company should be well established. When I say well established, I clearly mean to say large market capitalization companies. Okay, companies which have a market capitalization of somewhere in the range of around 10,000 crores and above, only they are eligible for fast track issue, right? Second, as I said, available only to those companies that are already listed either on BSE or NSE for 3 years. Okay, the companies who do not want to follow FPO but they want to generate money very quickly, the only condition is they need to be a well established companies with a legal compliance companies. So next point is they should have been listed in any of these two stock exchanges for the last 3 years and their market capitalization should be minimum 10,000 crores. Okay, only then they are eligible to get qualified as fast track issue. Not only that, the last point is also very important. Okay, it says trading on the security market should comprise of 2% of the total listed shares. Now, if this is difficult to understand, it says that suppose of today, okay, suppose today 100 shares have been traded. When I say trading, some shares have been purchased, some shares have been sold, whatever. So if there are 100 shares that are traded today, okay, and total value of those 100 shares as of trade and buying and selling, if the total value of the trade that has happened today is, let us say, 1,000 rupees, 2% of it, 2% of 1,000 rupees should be only applicable for this company. Are you able to understand the whole logic of it? That means if today the stock market has done a business of say 1,000 rupees, what is 2% of 1,000 rupees? What is 2% of 1,000 rupees? 20 rupees?
20.
Okay, so at least 20
Yes, sir. 20.
20 rupees of business should come only from this company which is trying to make a FTI. Only if all these conditions are satisfied, then you are eligible for fast track issue. Otherwise, you are not eligible for a fast track issue. Clear with the concept? These things are a bit difficult to understand, but still I'm trying to reduce the complexity of it. First, it was introduced in India by SEBI in November 2007. It is applicable only for well-established, good companies which are legally compliant. That means there are no legal cases against that company. That company is legally correct. Okay. So such companies can issue shares, normal equity shares, or they can also issue right shares. Okay, it is applicable for only those companies, okay, who are already listed on any of these two exchanges, and their listing is minimum for 3 years. Okay, their market capitalization in the last 1 year is minimum 10,000 crores. Okay, and out of those, out of the whatever trade that has happened, that has taken place, this company's shares should have contributed at least 2% of the total trading volume. Only if all these conditions are satisfied, then only you are eligible for FTI. Otherwise, you are not eligible for FTI. Clear? It takes time to understand all these things. Okay, but still, if you have doubts, just let me know. You might be wondering, what do you mean by market capitalization? Market capitalization is nothing but It is a multiplication of two figures. Price of the share into the number of shares that are available for trading. Say for example, price of one share of ITC today is 140 rupees and there are 100 shares in the market that are available for trading. So price is 140, 140 into 100 is how much? 14,000 rupees. So 14,000 rupees, okay, is the market capitalization of ITC. Okay, like this, any company who wants to issue shares through FTI, their market capitalization has to be minimum 10,000 crores. Okay, so their minimum capitalization has to be 10,000 crores. Only then they are eligible for issuing of shares. Clear? Any doubts in this?
So about net worth you told so yesterday.
Yeah. I want some information about net worth. How many of you have gone and checked what do you mean by net worth? Okay, Rohin, can you tell me what is net worth? Assets minus liabilities, okay. Somebody responded as assets minus liabilities.
So net worth is a measure of financial health. It basically says what you would have left over if you sold all of your asset to pay all of your debts.
Okay.
So I have seen even the types of it and the different types of net worth or the formulas. They always say that net worth is the total asset owned by an individual or business, less any debt obligation and any other financial liabilities.
Okay. So I'll just put it in the correct way. It is
Yes, sir.
assets minus long-term liabilities is your net worth.
Yes, sir. Yes, sir.
Plain and simple definition: assets minus long-term liabilities, not short-term, but or not current liabilities, but long-term liabilities. That is your net worth. Clear?
Yes, sir.
Any other answers? Fine. I don't know whether you are active or no. All other people. Okay. Fine. We'll just read through this concept called as private placement. Okay. So what do you mean by private placement is, I'll just explain to you what is a private placement first, and then we'll go into the main definition and whatever points that are mentioned. Okay, first thing. Now, pay attention here. Private placement. Okay, the word itself, private and placement. Private means this offer of shares is not applicable for the general public. It is made only for specific people. And who are those specific people? They could be either a financial institution, they could be corporate bodies, or they could be HNIs. HNI stands for high net worth individuals. People who have ample amount of money. Okay, they are called as HNI, high net worth individuals, and it is also applicable for financial institutions and banks, and also applicable for corporate bodies. Right now, have you heard of a company called Bennett Coleman and Company? Have you ever heard of a company called Bennett Coleman and Company?
No, sir.
No, sir.
Times of India. Heard of this company at least?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Times of India is just one product of a company called as Bennett Coleman and Company. Likewise, their other product is Navbharat Times. Okay, their channel is Times Now. Next is Economic Times. Okay, then you have Navbharat Times, Hindustan Times, Times of India, the Economic Times. Then you have one more. I think in Maharashtra they have a paper called as Maharashtra Times. So all this is nothing but a product of Bennett Coleman and Company. Okay. Now Bennett Coleman and Company, when they wanted to venture into all these various products, they required huge amount of money. Okay, but they said we don't want to make a public offer. We don't want to get into all these details because this is time consuming. This is very risky. We don't want to go through this. We want to raise money in a different way. So that company tried to raise money in the form of a private placement. Okay. Now, what is a private placement is what I'm going to explain to you. I think the meeting will end in a couple of minutes. I think it will be over in a minute or so. But I'll try to explain. If the meeting ends here, kindly log in quickly. I will just take another 10-15 minutes and then we'll stop it. Okay. So let us continue. Even if it stops, you please rejoin it. Fine. So any company who does not want to follow IPO or FPO method can issue shares through a method called as private placement. And when I say private placement, that means your shares, you don't offer it to the public, you offer it only to few people. Probably you could offer it only to one person, okay, or you could offer it to multiple persons. So you can offer this to a financial institution, you can offer it to corporate bodies, you can offer it to high net worth individuals. Now, what happens in this particular situation? In this particular situation, okay, these financial institutions or corporate bodies or HNIs, they will purchase all your shares. Okay, they will purchase all your shares and they will give you the money, right? So what is the offer that you are making? You are offering 10,000 shares at a price of say 1,000 rupees per share. So 1,000 shares into 10,000 rupees per share, they will multiply it. Whatever money is required, they will give that money to you and they will take those shares. Okay. And what will they do of that particular shares? Later on, when they feel that your company is really doing well and you have started earning profits, they will sell these shares to the general public at a whatever price that they want to do it. Are you able to understand? So here, as a company, you need not be worried about whom to approach, how much time is it going to conduct. No, just give them the shares. They will take your shares. They will give the money to you and you can start your operations. Later on, when you start making profits,